Hi, I'm Patu from freefincal, and in this video let's talk about how to invest in the Nifty Large Midcap 250 index. Well, one cannot directly invest in this index because there's no index fund or ETF tracking this index as of now, but there is a way to do it by combining Nifty 50 and Nifty Next 50 index funds, not ETFs. And we are going to talk about that today. A couple of people had expressed interest in this in one of the YouTube videos, so I thought I will uh, uh, do a simulation and find out how to do it. So this post has been published today. The link is in the description box for the full details, but I'm going to show you how I made the calculation. So first of all, what is Nifty Large Midcap 250? This is a combination of two indices in of itself. One is Nifty 100, that is 100 large cap stocks, that is stocks with the highest free float market capitalization on the NSE. That's Nifty 100. That's the large cap universe for mutual funds as defined by SEBI, and Nifty Midcap 150, which is the which is 150 stocks in the midcap space. That is the 101 to 250 in terms of market capitalization in the NSE. That's the midcap universe. So it takes 50% of Nifty 100, 50% of Nifty Midcap 150 and combines them to create this index. The rebalancing is done every quarter. Why is this index important? This index is extremely important because I had just published the active mutual fund equity mutual fund analysis performance report, and if you notice, I had compared the multi-cap category, the ELSS category, the large and mid-cap, and the value-oriented category against this index, the total returns index, that is where the dividends are assumed to be reinvested. And if you notice, there are 42 multi-cap funds, and if I expect a multi-cap fund to beat this index with 70% consistency over every possible 5-year returns, every possible 5-year return periods, that is 5-year periods, it's only 15 funds have managed to do that. And then if I impose what is known as downside protection consistency, I don't want to explain too much about this. It essentially means that the fund will typically fall less than the index. The link, you can look at the full link for this video, the video, and learn more about it. So notice that only 15 out of 42 funds have outperformed this index. 9 out of 31 ELSS funds only have outperformed, 8 out of 20, 7 out of 14. So typically, not even half the funds in these categories are able to beat this index. So this is an extremely important index, and if you believe in index investing, and if you want to lower your the expenses for your investing, then you can try to replicate this index using Nifty 50 and Nifty Next 50 index funds. Even if, well, Motilal Oswal had filed with SEBI an NFO for this index, but I think they have, according to what I hear, I think they have given up this idea, or they will be coming up with something else. In any case, this is a very tough index to beat clearly, and and this is something that index investors, especially young earners who want to choose index investing, can consider. So the question is how to replicate this. Well, even if there is an index available, that's what I wanted to say. Even if there is such an index available, there will be 250 stocks in this index, and I had recently shown that even large cap stocks in the NSE are not liquid when it comes to large transactions. So for a fund manager to keep the tracking error low for a 250 stock index, it will be quite a job. So even if there is such an index, I think using Nifty 50 and Nifty Next 50 would be a better choice for investors to manage this fund. So let me show you how I went. I'll show you the results, and then you can see. So this is the normalized evolution of the Nifty Large Mid Cap. That's the blue line. The Nifty 50 is the orange line, and the gray line is the Nifty Next 50. So excuse me, I have to get rid of this. Those are the three indices, and we are going to create the movement of the blue line using Nifty 50 and the Nifty Next 50. So to do that, I'm going to go over to the Excel sheet now. So I have done two kinds of calculations. I had shown in a video about how to create a hybrid fund, hybrid index. So I've essentially followed the same idea. You can look at that video. So this is monthly data excuse me, of Nifty Large Mid Cap 250, Nifty 50 and the Nifty Next 50. I got this from Nifty indices, taken the daily data, converted them to monthly data. Then these are the returns, the monthly returns of all the three indices. And what I have essentially done here, so let me go to here. So I have now created a blend return. So what I've done is I have taken, so this is K1 is 45, I've set it for 45. So I've taken 45% of Nifty 50 monthly return and 55% of Nifty Next 50 monthly return and created a blend monthly return. And from this blend monthly return, starting with a blend index value of 100, I've gone on to replicate the index movement, and you can see the index movement here. That's the index movement for 45% of Nifty 50 and 55% of Nifty Next 50. This is using monthly returns, which means that I'm rebalancing the index to this proportion every month. And what I've done is to how I came up with this 45-55 number is I looked at the maximum. I mean, I've looked at the return difference between the actual Nifty Large Mid Cap 250 index and the blend index, and I've tried to minimize this difference. And this is when the difference gets minimized. And that is one way to do it. This can give you slightly higher returns than the Large Mid Cap 250 because it's got more of Nifty Next 50. But a more practical way, see, the NSE itself rebalances between Nifty 100 and Nifty Mid Cap 150 only once a quarter. So monthly rebalancing will not be practical for investors. It's possible for a mutual fund where there is no returns, where there is no taxation for such churn. But since the NSE itself does only quarterly rebalancing, a more practical way is to do yearly rebalancing. So I have redone this exercise using annualized returns, not annualized returns, annual returns. So I've taken annual data, so there are only few data points here every year, and I've repeated the same calculation, and I found that 58% of Nifty 50 and the rest in Nifty Next 50, that blend can also reproduce Nifty Large Mid Cap annual returns to a reasonable extent. So intuitively, you can take 60% of Nifty 50 and 40% of Nifty Next 50 and create a blend and rebalance it once a year. That's very important. Unless you rebalance, you will not be able to replicate. That's essentially how you can replicate the Nifty Large Mid Cap 250. But even if you don't want to replicate, if you're investing in both these indices, you can use the Nifty Large Mid Cap 250 as a benchmark for the performance of your portfolio. So that's what I wanted to say in this video. Please read the full article for the details, and if you have any questions, do let me know. And also I have my Q&A coming up for this week, so if you have any questions for that, go ahead and leave them below. Thank you. Bye-bye.